Okay. Good everyone. Welcome to another financial modeling and validation community session. Today we'll be looking at applying scenario analysis in budget and investment decision. And today our guest speaker is Tsegbemi. So the financial modeling community is very sponsored by financial modeling institution and being powered by UrBizEdge. The financial modeling institution is it's more of like this school where you can learn about financial modeling. They also have some accredited exams which you could take, and we also have coupons which you could email, and we'll give you the email, give you the coupons to use for your coming exams. Then UrBizEdge is a registered Microsoft Excel consulting, financial modeling, business intelligence, data analyst, and enterprise solution firm in Nigeria. And we specialize in helping companies and high-value professionals be on top of their business data. We're also the developers of the Nigerian Stock Analysis Dashboard and also the Nigerian Financial Market Analysis tool, which is available on Microsoft Office Store. And also the brains behind the Nigerian Market Data Platform. So UrBizEdge offers physical classes as well as online classes, which I will share the link in the chat description. So today our guest speaker is Tsegbemi, and he has 14 years experience in the financial service institution. His experience span from performance management to data analysis to sales and customer service. And he loves providing insight to help businesses be on top of their business data by making quick and informed decisions. He also has an MBA in the University of Benin and is currently doing his master's in business analytics. Hello, Tsegbemi.
Yeah, hello, Ifeanyi. Yeah, I can hear you.
So you can present.
Okay. All right. Good afternoon, everyone. It's a pleasure to be on this call with all of you that are here. Thank you for making our time to be in this session. I will just share my screen as we start off. So please, I'd like a confirmation that you can see my screen. Can anybody confirm that they can see my screen?
Yes.
Yes, we can.
Okay, all right, thank you very much. So Ifeanyi has already given us what the topic is, and I also want to just appreciate UrBizEdge for the opportunity to be part of this session, which personally I've benefited from some of the Power BI sessions that they hold. I think there's one that usually holds around 4 p.m., between 4 or 5 p.m., and it has been quite helpful to me as well. So for this one, we are talking about scenario analysis and how you can apply it in budgeting and making financial decisions. So basically what our agenda today would be just a brief definition of what scenario analysis is. Then we'll look at the steps that you would take, the theoretical steps really, before we now go into the practical application. So it's more or less I would say, technical session on how you can apply Microsoft Excel in your scenario analysis application. So basically, for us, if you want to understand, when we are talking about scenario analysis, is you're looking at a situation and you are trying to evaluate what would be the possible outcome in the future. And you're looking at it, say, okay, based on what is happening, let's use Nigeria as an example. I'm looking at the current economic situation in Nigeria, and I want to forecast and say, in the next 1 year, what are the likely outcomes? So you now begin to play out a scenario. And that's why you see the person thinking about it. What's the worst case scenario with the Nigerian economy, for example, or what's the best case scenario that could play out within the next couple of years? Now, usually when you are engaged in the process of creating a scenario analysis, the steps involved will be, first, you want to define the issue. What are you really looking at? What is it you are trying to forecast? What are the variables you are considering to be important? So if you were looking at your personal portfolio, for example, for those who are investing in the stock market, and you're saying, I want to grow my portfolio by 20% so that I can make sure that within the next 4 to 5 years, I have a reliable stream of income that would serve me for a while. So you've first of all defined it. The next thing you need to do is gather the required information that will help you make the decision that you want to make. Then next with that would be to separate, as we say, what are the certainties and then what are the uncertainties. So certainties could be that I am very sure that in my current employment, I will be here till I retire. Maybe the person is a government worker. I am sure that regardless of the recession any recession that may come up or any shake-up, this job is guaranteed. Uncertainty could be that within the economy, we don't know whether inflation will continue to rise or not. We are not sure whether exchange rates will continue to depreciate further or not. So those are some uncertainties. And then once you've gathered those items, which we'll refer to more or less as your assumptions, the next thing would be to develop that scenario. Once you've developed the scenario, you can now go ahead to use that scenario for your planning. So at this point, I think we'll now move into the application in Excel. So I'll just run through these 2 slides and then we'll move to Excel to start off the practical session. When you want to do it on Excel, there are usually 2 or some tools, which is the what if. So if you go into Excel on the data tab in the tab menu, you can go to the what if analysis, which can help you to create scenarios. So there you have the goal seek, you have solver, and then you have scenario manager, of which we'll be looking at 2 of those those functions within Excel, which are goal seek and then the scenario manager. So I'll just switch my screen and then confirm that you can see my Excel sheet. Okay, so can we see my Excel sheet?
Yes. Yes, we can.
Okay, great. So usually when creating a model, it's always advisable you create a template that can be reusable, and that way it makes it easier for you when you want to do something else within your model. So to save time, I've already done like a small demo of this, which the 3 scenarios we'll be looking at first of all would be a personal investment plan. The next one would be a retirement plan, and then the last one would be a company investment at the company level. So I also, most times when creating this, what I also do is I try to link the sheets together. So instead of clicking here, most times I could use the menu tab to do that. So first, we said we are defining the issue. So in looking at the personal investment plan, so let's assume this person now is saying, I want to achieve a certain level of savings. So we'll create that. Usually in budgeting, you would, when you're doing budgeting, most times either 1 year or a long term, there are usually 3 scenarios that would be created. The first one would be the base case scenario. The base case scenario is as things are currently. Then usually you would have like a best case scenario. So if things are on the upside, what would they be like? And then the last one would be the worst case. So if things don't go as we anticipate, what would the outcome likely be if things don't go the way we planned? So sorry. Okay, so we've put these 3 out, which is the base case, the best case, and then the worst case. And then for the first one, we're saying, let's assume, first of all, on my current, what do I have as my savings balance? So so first case scenario, the person maybe in a sense, he doesn't have, let's say if base case, he has 50,000. That's what he's starting off with. The best case, he started off with a savings deposit in his account of 100,000. And then the last person's situation is that he has 0. Then we ask, okay, what would be the monthly contribution? So I have a target to save a certain amount. How much do I want to be saving on the monthly basis? So possibly this person works with the private sector and thinks I can cough out, say, 30,000 naira for my monthly salary as savings. The best case scenario, this other person possibly is working with an oil servicing company and feels, well, I think I can do 50,000 on a monthly basis. And then the last person, worst case scenario, might be like, well, I'm in my own business, things are not looking so well. So let's say I would do a contribution of 10,000 naira every month. And then we also look at, say, what's the annual percentage yield, which would be more around the interest rates. So base case scenario, well, let's use the benchmark of the MPR rate currently, which is about 30% of the MPR monetary policy rates. Sorry, let me not speak. So for that one, for the monetary policy rate, for those monetary policy rate usually is when the CBN advises what the rate is that they would lend to banks. And then the CBN has stated that they will be doing 30% of the monetary policy rate. I think they're about for savings, maximum of 30%. That's what banks can offer savings deposits. So using roughly about 4.6%. Best case scenario, the next person is able to invest his money with possibly a mutual funds investment and gets the returns of, say, maybe 8.5% on his deposits. And then the last person, this other individual, possibly he doesn't have any way he's saving his money. So for this individual, his investment doesn't accrue any real gain for him. So these are the three scenarios we have. So what we're going to do now is that we're going to plug this into our template here to say, okay, let's run it and look at how much would I save? How much will I have after a period of time? So the last one would be the duration. So let's just take the duration. So the first person says, let's say all of them are going to save for 5 years. So let's just do 5 years for each person. So each of them is 5. Sorry. So each of them is going to do 5 years. So we'll just put that. So in a sense, those would be like our assumptions, and then we'll just plug that in for each of them. So the first person, 50,000. The first person's monthly contribution, we said, is 30,000. Annual percentage yield is 4.62%. The savings duration, we said, is 5 years. So the question now is, how much would be the savings at maturity? Withholding tax, as we know, is 10%. So we'll just have that constant there. All right. So now what we are going to use quickly is the function that is known. So usually, first of all, let's at least try and name these items to see what they would be like when we are using Excel. So this first one would be the current savings account. We'll say this is the present value of his savings. The next one would be like, what are the monthly payments? So we'll call that payments, PMT. The annual yield will be the rate. The rate will be the duration. We'll call that number of periods. Number of periods. And then lastly, the value of the savings at maturity will be the future value. So using that, we have the function, which is the FV, future value function in Excel. So which would FV, open and then Control A. Usually, sometimes you could go ahead to just type it, but for those who would need, it's helpful to also see what this pop-up box would show up so that we can just key in the numbers. So for the rate, we know that the rate is 4.6%. And you know that the 4.6% is per annum, and the interest will be paid on a monthly basis. So we'll divide that by 12. The period is 5 years, and that's so since we are doing a monthly period, you multiply that by 12. Sorry. You multiply that by 12. the monthly contribution, which is the payment, is 30. And then the present value, which is 50,000, we'll take that. Now for the type, assuming the payment is coming at the end of the period, that would be represented by 0. So you will see the explanation there. And then if it's coming at the beginning of the period, maybe the person gets the makes the contribution at the beginning of the period, we'll put 1. But for this scenario, we're only putting we're leaving it blank, which is equals to 0, since it's coming at the end of the period. And then we'll pop out to see what would be the person's savings at the end of his at the end of 5 years. So note, it has a negative value because it's assumed that the money is leaving. So what we just simply do is put a negative minus sign here to turn it positive. So this is the first person, the first case scenario. So for this person, if we were to save for 5 years, he would get a return of about 2 million roughly. And then we'll quickly, so what we'll now do is we're going to use, so I said we'll use the goal seek, then I'll come back to that. So assuming he was saying he wanted to save 5 million, we'll go to data, come to what if analysis, and then we'll come to the goal seek. So the goal seek is saying this value here, I want to save 5 million. So you change this to the value portion and say 5 million. And then by changing which cell. So the question is, which cell do we want to change? So let's assume we want to change our monthly contribution so that way we can achieve 5 million naira in 5 years. How much do we need to save on a daily basis? So you will see that for here, if you are going to achieve a savings of 5 million, you need to do 73,000. So already you are playing out the scenario and you see what it's like. If I need to save 5 million in 5 years, I need to make a monthly contribution of 73,000. So I'll go back and then we'll now move quickly into using the scenario manager for this purpose. So this first scenario, we'll call it our base case. And what you now need to do is we're going to use scenario manager. We need to save this scenario. So I'll come here, scenario manager, click on that. Okay, so let me delete the ones that I created earlier. All right, so I'm going to add this now, and I'll title this our base case. So, so the question is, what are the cells that are changing? So I just select the cells. So this is changing, which is the current monthly savings. The monthly contribution will also change. The annual percentage yield is changing, and then the savings duration can change. And then I put a comment here. Base case scenario is based on the assumption that monthly savings will attract or will earn a yield of 4.62% with a monthly contribution of 30,000. Or we'll earn a yield of, let's leave it at that for now. All right, so we click OK. It will show us what are the cells that are changing. You could actually come into this place and change it, but we'll leave it at this because we are going to use it to generate a summary report very soon. So this is our base case scenario, first of all, and you click OK. So you can see it has saved it. And I close that. Now, the next one is the best case scenario. So best case scenario, we say that he had 100,000. He started off with 100,000 with a monthly contribution of 50,000 naira. His yield is 8.5%, still 5 years. And you can see automatically, we see that here, he was able to save 3.8%, 3.8 million rather, thereabouts, at the point of maturity. So here again, all I just simply do is come to the goal scenario and then add it. So I'm going to add this. This is the best case. So what Excel has done is the initial changing cells that I keyed in have been saved. So I don't need to do anything again. All I will just come here is to say, what is the scenario? So I say best case scenario is based on the assumption that savings is contributed to a mutual funds investment. So let's leave it at that. We okay it, and then we okay it. So if you look at it, or let me just do the last case before I do show. So here I come back here. We said the worst case scenario is that he doesn't have any savings. He's saving 10,000 naira every month, and then that savings does not attract any interest for the 5 years. And we can see that in 5 years, all he has is 600,000. That's all he has in his account. And then we'll do the same thing again. We'll just save that scenario. So here we have the worst case scenario. I add it. Worst case, and then we state that as well. Worst case scenario is based on the assumption that savings is warehouse, or savings is warehoused in a current account that does not attract or that does not earn any interest. So we are done with that. Now, so those are the 3 scenarios. So if you look at it, this is base case, if I click on show here, you will notice that on this side, the inputs have changed. If I click on best and then click on show, you'll see that the inputs have changed. And then if I click on the worst case scenario and click on show, you'll see that the inputs have changed as well. Now, if I had maybe a management report that I needed to do, I could just click on summary, and then the summary would give me the details, would put all these scenarios into another sheet, and then I can copy that and move into Excel. So let's run that. But there's something I would just want to show us, because if I do it this way, it would give you. So let's do that. So we've said the cells that are changing. So I'll take out D16. So I have D10. So I can change the cells, the resulting cells. I can just pick the ones I want to show up. So that's current, monthly contribution, annual yield. And then, so since I'm not using the withholding tax one for this purpose, for this scenario, for this analysis. So if you look at it here, it has given us a summary report. But as I said, because we've not titled those cells, what is showing here is just showing you the cell reference, and this is not helpful. So I'll do something now so that we can rerun that, and then we'll just look at it quickly. So if we come back here instead, normally in Excel, you can reference, you can give this cell a name. Instead of it being D8, I can give it a name. So what I want to do is I would name all the cells and then use what we call name manager to quickly name it and then rerun that report. So this is current savings. So I just use current savings, monthly contribution. Okay. Then we have instead. So let me do something. Instead of using it from left, let's use it this way instead. All right. So what I would do would be to come to formula, create from selection. So we are using the left column. That's what we want to use. So we want to create names for these cells from the left column here. And then we click OK. Now, once we've done that, if we come here, you would see that these cells have been named here. So if you look at the top here, the cells have been named. So if I come to monthly contribution, the cell has been named. And all I just simply do is go back to my scenario manager and run that report again. So if I come back to scenario manager, what if analysis, scenario, and then I run that report again and OK it. So now you can see that in this scenario, it shows me, and then if I open up this, here, all the assumptions that I made while preparing this slide are also stated there. So you'll just see all of them there. The scenarios are here, and then I could collapse this, just copy and paste this cell alone and take it to Excel. So that's where anybody who wants to look at it, instead of having to go to scenario manager and keep clicking on show, already looks at this and can see it once. Now, We'll move into the next one quickly, which is we want to now do this. So what we want to try and do here is to say, let's create a drop-down menu, which is we are using like a data validation. And then we'll use the index and match function to create our scenario. So here we use scenario manager to create this. In this one now, what we have done is, like we said earlier, when you are doing the scenario analysis, one of the things you do is as you look at what are the certainties and what are the uncertainties. So usually you could have a separate sheet which you would warehouse your assumptions. So like here, what I had here in the first one was that the assumptions were stated here were stated in the Excel sheet. But in this one, instead, what we want to do is we've created a sheet. For the sake of time, I've just already done that, where the assumptions are already stated in this sheet. Okay. Okay, what we'll do, let me just finish this. You can drop your question so you don't forget it, and then we'll come back quickly to that question. So I can see the chat. So let's just finish this one, this retirement investment plan, which is a common scenario, and then we'll come to the question that you have. So you can drop it, and then we'll take that question quickly. So for this one now, what we want to do is use a data validation, and then we'll use index and match quickly to run the scenario. So instead of using scenario manager, as we said, we can also use the index and match function to run that analysis, so that way we get the inputs that we are looking at, that we want to see. So for this one now, first of all, since I'm using the data, as I said, I'm going to be using the scenario. I'm going to be using data validation. The first thing I will do here is to say, okay, let's pick a scenario, and then we'll start off with that. So inside data validation tool, I create a list, and then the source of that list will be this sheet where I have my assumptions, and then I select these 3 cells here. Okay, so already, if you click on here, you already have the 3 cases, which is the best case, the base case, and then the worst case. Now, what we are going to try to do is make sure that at each time when I click on this, use this data validation, it can easily reference my assumption, so that way I don't need to come back to the what if analysis when I'm doing that. So basically what we now need to do is using that index function, using the index and match function. So we say equals to index, bracket open. As I said, you can use the pop-up box, so it makes it easier for some persons, so we could easily run it without having to go through that. And then it says, what is the array? What is the table you are referencing? And then we come here, we're referencing the whole of this table in the index function, and then you also need to lock it, so that's so relative reference, so that it doesn't keep moving around. So we've locked it, and then we come back here to say, what row number are you looking at? And then for this one, we're going to use the match function. So we come to say match. So in the match, what am I looking for? I want to look for the RSA balance. So if I'm looking for the RSA balance, please also do your relative referencing. You lock that. And then what is the array? What area, the table am I looking at it up from? And I'm coming here, I'm looking at it from here. I also lock that as well, so that it doesn't keep moving. And then here, the question is match type. Is it an exact match or not? So what I want is an exact match for that. And I just put 0. Now, if you put a 0, what you will see is that it is referencing the second column. You would see that from that place now. So the second row in that column, which is where the RSA balance is. And then we come back into the index function because we've not finished. You put the match function again, and then close that, and we come back here. When we come back here, we are saying, okay, now this time we want to reference the worst case scenario. And then in referencing the worst case scenario, we'll lock that because we don't want it to be moving around. And then the lookup value is, we come back to our assumptions and we highlight these headers because this is where we are looking up the values from. And then we say that the match type is an exact match. And then we go ahead to OK it. So if you, so I should have, sorry, let me go back. I don't want to just, so, okay, so if you look at it, you see that the answer here, which is at this point, is 0. And I click on that because if you look here, the worst case scenario, the RSA balance, the person started with 0. RSA balance means retirement savings account balance. So that's 0. And all I just simply would do would be to duplicate that function across board for all the cells. So the person started his working age at 30, contribution. So just to make sure that these cells have the correct style, rather. And then his working duration is 35. So here, sorry. So I just put. Okay, so we'll come to that question. All right, just a minute. We'll come to that question. So I'll try and be fast on that. Okay, so the same thing we had done in the other cell, we're going to run that again here on this. So first thing, we're looking at what is the future value, because he started with an RSA of 0. So this person started working at 30 years. He had an RSA balance of 0. And then his monthly contribution was 20,000. And then by the time he retired, by the time he worked for working life duration was 35 years. So we'll come down to the last, but let's complete this one. So we want to see what is the future value. So we say the future value of that is, so we'll come with that future value. We'll come back again. What's the rate that he's earning, which is 12 divided by, so that's 8% divided by 12. Number of periods is 35 multiplied by 12. The monthly payment is 20,000. And then the present value, we say the present value is 0. And the match type is 0 since at the end of the month. So please note, you need to put the negative value to show that the money is coming back. So here you would see that if you were to work for 35 years at point of retirement, so if he was to work for 35 years, yeah, working life duration is 35 years. So at the point of retirement, he would have a savings of 45 million. So I come back here, and then what's the age at retirement, which would be the sum of his starting age plus his retirement age, which is 65 years. Sorry, let me copy this format, put it here. Okay, so I think, just a minute. Okay, let's undo that. So balance at retirement would be the amount that he saved at the point of retirement, which is equals to this. So the monthly withdrawals, we can make an assumption that for this person, his monthly withdrawals would be, say, 200,000. So that's 200,000 as his monthly withdrawals. And then he now takes that money and saves it with another mutual fund where he can get a return of, say, 10%. Let's say, okay, no, this is worst case scenario. So worst case scenario, let's say he gets an investment of, say, 5%. So, and then at the time of his, let's check something. I think okay, so yeah. So I just need to copy that. So just a minute, let me pick that function because I already keyed it in at the other place. Okay. So it's supposed to be here. Just a minute. Okay. Okay. So, yep. Okay. So at the point of his, worst case scenario, yep. So at the point of death, we'll say maybe he was 80 years old. 80 years old, and then number of years post-retirement would be his age minus this one, minus that. And then the same thing, we'll just look at if he were to leave an inheritance for his children. So that would be the future value that we're looking at. So the rate would be, we are using this rate since that's the rate that was going divided by 12. And then the number of periods here would be 15 years multiplied by 12. The monthly payment. So in this one, it's going to be a withdrawal. So we are going to put a negative sign here. And then the present value would be this balance here, which is what he ended up with at the point of when he exited from his, when he was post-retirement anyway. Okay. So if we see that, so at the point of retirement, or rather when he eventually passes on, you will see that what he has here is 255 million, which is what he would leave as the inheritance value for his children. So if I come here and I select maybe best case, you'll see the scenario changes. If I come here again and I select base case, you'll see that it also changes again. So just something, so best case, I can see that has changed. Yes, worst case, so let me confirm base case. Okay, yeah. So with that one, all the person needs to do here is he just comes and clicks on each of these options and he can see the scenario change. So the best case is with the person saving 50,000, he started working at 22 years, had a value of retirement at 113 million. Then by the time he finally is parting from planet Earth, you will find that because he was able to get a yield of 10% on his post-retirement savings, he still lives with about 2.8, which is quite a lot for him because he still lived about 28 years post-retirement. Then if you look at the worst case scenario, the person just did 15 years and was withdrawing 300,000. So he lives with that. So on that, we've seen what it would be like when you are now doing that analysis. Say, okay, I've seen what it's like if I'm saving a particular amount on a monthly basis for myself. I've seen what it's also like if I'm retiring. And then what we've been able to do is you've been able to look at it to see how I can use the scenario manager to create that analysis and then also create a summary report. And at the same time, also use the index and match function to create this as well. And the last one, which we are supposed to take, would be the company. So I'm going to do a scenario for a company. And then in this one, I would use the switch function in doing that. But before I go ahead, maybe we could just take one or two questions in between before I proceed. So I think I saw a message drop in the chat.
There was a scenario in the chat someone posted.
Okay, so the person says, I'm currently 58 years and retired. What should be the rate of investment into which I could put my gratuity of 50 million naira into that will, okay, that will give me about 800 million in 12 years with or without additional 50, okay, with or without additional 50,000 naira. Okay, so what the person, if I understand this question, please let me be clear before I run that scenario. So the person is saying that he's 58 years old at the point of retirement. So let's try and key that in. So I'll clear all of these ones here. So let's say this would be, so for us to be, so he started, let's assume he started working at 30. And then for him to be 58, it means that he would have worked for about 28 years. So his age of retirement is 58 years. So that's the first one. What should be the rate of investment into which I should put my gratuity of 50 million? So we would assume that the value of his retirement savings is 50 million rather. So I need to take out 10 from there. So 50 million into that will give me about 800 million naira in 12 years with or without additional 50,000 naira. Okay, so for this one now, we're saying that he has 50,000. At age of retirement is 58. Number of years post-retirement will now be 12 years. That's what we'll be looking at for this. So we can discard the age of death since we're not using that for this analysis. And then what the person wants to achieve is that at the point of maybe exiting, let's assume he wants to leave an inheritance of 800 million. So what we now want to do is we need to get 800 million in this place here. Now note, we can easily use the goal seek, but note one thing, for goal seek, we would need to ensure that the formulas, because most times if we try and use it, it would give a prompt where there are some functions inside it. So let's use that as an example. So we're going to use goal seek, for example, to run this sample. So he's saying that this value of 202 million, he wants it to be 800 million. And then what he wants to do is we need to change this annual percentage yield so that at the end of the day, he can get that 800 million. So as I said, because there's a formula inside, so I need to change this into a formula first of all. So I'll just change this to 8%, and then let's run that again. Okay, so if you were going to get 800 million, with the fact that he's still withdrawing 300,000 from that amount on a monthly basis, he would need to get a yield of 21% on that initial retirement balance, so that at the end of 12 years, he would have 800 million. So let me be clear, Rotibi, does that take care of the question you just asked us here? You can drop a message in the chat if you are fine with the response. So as I said, retirement age is 58. He had.
Hello.
Yes.
Are you there? Okay. This.
Yes,
Yeah. There's another part of that question. I said, assuming I'm making 5,000 naira contribution in addition to that, that would have been maybe the best scenario. And the worst scenario is that I'm not even putting anything at all. So that's the question.
Okay, when you say adding,
the first one that I'm put.
Okay, go ahead. Sorry, I'm listening.
Yeah, so I want us to look at both the base case scenario and the worst case scenario. The base scenario, okay, there's the 5,000 naira every month in addition, and the worst case is that there was nothing was adding to that. So I wanted to I wanted to know. I wanted to look at the rate. What would be the rate of investment that could produce that figure? I'm looking at. That's the question.
So let me recap. When you say 5,000 naira addition, what you are saying is this monthly contribution, is it in addition to this 20,000, add 5,000 naira to it?
No, not even 20,000. From the pension, what I could be able to comfortably put aside is 5,000, not 20,000.
Okay. No.
I've collected that lump sum. That's it now. Okay. The lump sum is there already.
The lump sum is 50 million. So monthly. So instead of withdrawals, what you want is 5,000 naira addition.
They won't be withdrawal at all.
Okay, no, so let's change this to 5,000.
Okay.
And let's see what that would be. So you would be doing so this would be 8%, a yield of 8% for a period of 12 years to give you 131 million. So you're not making any withdrawals. You are just saving. So your retirement amount is 50 million with monthly contribution of 5,000 at a yield of 8% for a period of 12 years will give you 131 million. That's scenario one. Scenario two, how much do you state in scenario two?
So in scenario two is okay. Assuming I'm not even adding anything at all. No, so 5,000 monthly, and there's no withdrawal.
Okay,
no
so
withdrawal, no additional.
Okay, 5K. So scenario two. Well, for scenario two, if you are still running it at 8% yield, you would end up with. So for this one, without any withdrawal. That's sorry, no monthly contribution, and it's
no
still
contribution.
running. It's running
no,
at
no withdrawal.
8%. At 8%, you will still
Okay.
end up with 130 million, really. So the difference is really marginal between the both of them.
Oh, okay.
Yeah. So let me put it back again. So this is 130, and then add your 5,000. This is 131. So it's just about 1 million naira difference between the two. So I think we're good there. And the last one, which is the company investment scenario, which I said we're going to use the switch function. The switch function operates more like the ifs function in a sense, and then you can use that. So I'll try and run that quickly because I know we've said 1 hour, so we want to try and see how we can keep to that. I think we have roughly about 15 minutes to go thereabout, but let's see how much we can cover. So I've already created the scenario to say, yes, the revenue of the company. So as we said, define the issue, and then we also need to look at what are our assumptions around that. So we've said, okay, our assumptions around there would be, what is the revenue growth? What is the cost of goods? What's the cost of goods sold? What's our overhead? And then what's our tax rate? So those are the items. Now, I've already prepared that inside here so that we don't take too much time, because I've taken some time to build all of that here. And so we've seen, so the scenarios are here. What we now want to do is to say, okay, using the switch function, instead of using index and match, I want to use the switch function to select my criteria and then run that. So I'll do the same thing here, which is to create a data validation for that, which would be, I just come to data validation. So I'm creating a list from, I've already created it here. So I just pick from here, best case. So I'm only going to do 2 scenarios here, best case, worst case. And I okay that. So I have my best case scenario and I have my worst case scenario. And then I come into this place here to start to use the switch function. So as I said, the switch function operates similar to the ifs function. So if I use the switch, here I'm coming to select, okay, what's the expression? What is like call it the indices, sort of like if you're going to use an if. So I come here, the expression I want to pick here, which I've already stated here, is this box here, which is I'm measuring the worst case or the best case, and then I lock it. All right, so that's the first thing. Then I now come back and quote it again to say, I could hard code, but this will be more like hard coding anyway, because we're saying it's more like the if function. So if it is the worst case, which is what we've selected, what would the results be? So I come back here and I select that particular item because I'm saying that's revenue on that. If it is the best case, what would the result be? So I come back here and I select the best case here. And we are done with that. So you would see that the answer here, because I selected the first one in the drop-down menu is worse, you can see that the answer here is 0.5. That's 5%. So that's 5%. So all I just simply do here is replicate that across board. And then, so let's use it here. So if I select best case, just a minute. Okay, sorry, I wrote base case instead of best case. So that's one of the issues with this, if you are, because it's more like hard coding. All right, so worst case, it switches to this option. Base case, it switches to this. So all I just simply would come here to do is to fill out that. So as I said, revenue is based on percentage growth. So that'll be 1 plus the percentage growth. So that's that. We said cost of goods is a percentage of revenue. So that will be equals to this multiplied by percentage of revenue. Gross profit, we know that gross profit is revenue less cost of goods sold. And then we also would look at overhead. So overhead, we say, is the percentage of revenue. And then the earnings before taxes now would now be doing gross profit less our overhead. And then the taxes, we said tax is a percentage of the earnings before tax. So that will be here multiplied by the tax rate. And then we know that the earnings after tax would be our earnings before tax less our taxes. And then we're good. All right. So we're done. So all I just do is if I switch this, it changes the scenario. And if I switch this, it changes the scenario. So I'll just add this. So usually sometimes when you are creating the model, you might not want the users to see this particular assumptions sheet. So what I can just do is if you have developer tab, you can come to developer, view code, and then come to the assumption sheet in particular. This is under the VBA, and then I would hide it. So that I'll just click on very hidden and close it. So the users will not be able to see that assumption sheet. Even if they try, they right click, they won't see it, except they go to view code and then they unhide it. You can also password that sheet in the VBA so that the users are unable to see. They need to get the password for them to unlock that assumption. So that way, whatever assumptions you have used when creating your scenarios, the users will not be able to see it. And then maybe depends if it's for privacy reasons, you can always go ahead to explain that to them. But that's an addition that at least anybody who wants to use it, maybe you have a sheet you don't want someone to see, you can just use the VBA code to hide it instead of using it. Because if I was to use hide, normal hide, you can always come back here to unhide it. But so you see unhide. But with that one now, it's not possible except I come to view code. There's no way the person will be able to do it. So if I come back to view code, assumptions, and then I come back here to sheet visible, the sheet now becomes visible to the user. So I think at this point, I would say bring it to a close. If there are any questions, please feel free to ask at this point. Thank you very much. So I will hand over to Ifeanyi.
Tsegbemi, thank you so much for that session. I don't know if you can hear me. Can you hear me?
Yes, I can hear you.
Yeah. Oh yeah. So thanks so much for that session. Thank you so much for the session. If there are any questions, you could ask him. If there are any questions. I think that was the only question in the session. Well, also again, you also because like I dropped his LinkedIn, so you could maybe connect with Tsegbemi, and you should be conscious and respectful of his time as well. That's the idea. But yes, well, thank you so much for this session. I hope to see you again.
Okay. All right. Thank you.
Thank you. And so I'll be ending this session now.
All right. Thanks.